I want to talk to you about chasing the top performers because that's something I think a lot of people are interested in doing. We see this happening year after year after year when companies report the best performers for a particular quarter. The next quarter, that those funds get a lot of money poured into them, but that doesn't guarantee they're going to be the best performers that quarter. So I just want to show you what happens when you chase the top performers. And I'm using the Callan periodic investment table that I talked about way back in chapter 6 or something like that. Um, it's got those 9 different indexes and it's got their returns from 1993 through 2012. And I had the spreadsheet just highlight the top performer in any given year. And normally when a number is coded red, that usually means that it's negative and it's bad, but in this particular case, the values that are red are the top performers for that particular year. And we have an interesting 20-year period. For 4 years in a row, the S&P 500 Growth Fund did pretty well, and for 5 years in a row, the MSCI's Emerging Markets Fund or Index did really well. It's unusual to have an index be the top performer for so many years in a row. So this is actually a pretty interesting phenomenon. So basically, the very first year, I found the top performer. That was the Emerging Markets Index. And so I'm saying, since we didn't know it was going to be the top performer until right at the end of 1993, it wasn't until 1994 that we started investing. And we looked to see which index had done the best for 93, saw it was the Emerging Markets Index, and so we put all of our money in there in 1994. Well, in 1994, this particular index didn't do that well, but that's where our money was. So I have us earning a negative 7.32% in 94. And then at the end of 94, we looked at these 9 different indexes, chose the best performer that happened to be the Europe, Asia, and Far East index. So we sold all of our shares in the emerging market index and we bought the Europe, Asia, and Far East index, and that's where we kept our money in 1999. In 95. In 1995, the Europe, Asia, and Far East fund or index did pretty good, but not as well as some of those others. So we had all of our money in the Europe, Asia, and Far East index in 95, so we earned 11.21. At the end of 95, we looked at all of these indexes, found that the S&P 500 growth had done the best that year, so we sold all of our shares in the Europe, Asia, Far East fund and bought shares in the S&P 500 growth index. Now, we bought shares in this particular index because it was the best performer the preceding year. Well, this actually seems to be a really good thing because it was the best performer in 96 as well. So we earned that return. We didn't sell it. We held on to it because it was the best performer in 96. So we held it throughout 97 when it also was the best performer. Held on through it throughout 98 because it was the best performer in 97. So we had these 3 years where we did quite well just because the S&P 500 growth index was the best performer. We held on to the S&P 500 growth throughout 99 because it was the best performer in 98. It did well, but not nearly as well as the emerging markets. At any rate, we earned 28.24% in 99. Bought emerging markets at the end of 99 because it was the best performer, held on to it throughout 2000, lost 30.61%. So that's the process I followed just to tally our return in any given year. And I didn't do the last couple of years because I wanted to do it on screen right here. So in 2010, we would purchase at the end of this year, shares in the best performer, which was this particular index, and we'd hold it throughout 2011. So our return in 2011 would be a loss of 2.91%. The best performer in 2011 was this fund, so I'd buy it at the beginning of 2012, hold it throughout 2012, and it earned 4.21%. So here are my returns from chasing the top performers. I'd also have any fees or commissions I might have to pay to purchase an ETF or a mutual fund, redemption fees or deferred sales fees that I might have to pay to sell shares of my fund if they have those load fees, which hopefully you'd buy funds that didn't. But these values in row 14 do not include any of that. And notice that I've only got 19 years of returns instead of 20 because I didn't start this process until the end of 93 when I knew which index was going to generate the top performance. To do this for 20 years, I'd need 1992's returns, which I didn't have. Okay, so now I want to calculate my mean return. You would add all 19 of these returns together and divide by 19. Or I can just use Excel's average function to do that math for me. So it generated a return of 11.42% with a standard deviation of about 25%. Which actually seems pretty good. It's actually higher than almost any index by itself. This particular index dominated chasing the best performers because it has a slightly higher return and a good bit less risk. But I want to show you that this 11.42%, and actually all of these numbers as well, aren't actually the numbers we should be using. And I know I used them in class, and I was okay with using them in class, but I want to do something just a little more technical. Basically, I want to pretend that I started with, let's say, $10,000, and I poured it into the top performer at the beginning of the next year, so generating a loss of 7.32% in 94. That $10,000 would grow to I'm just using the future value formula. Future value is equal to the present value of 10,000 times 1 plus the rate that I earned to the power of time. In this case, time is just 1 year, so I could raise it to an exponent of 1, but I don't have to. It'll give me the same answer if I do that or not. This is not a percentage, it's a dollar amount. So basically, my $10,000 at the end of 94 would have dropped to $9,268 from owning my shares in the Europe, Asia, and Far East. Actually, the shares that I owned were in the Emerging Markets Index Fund. So now at the end of 94, I'm ready to sell my investment in emerging markets and pop it into the Europe, Asia, and Far East Fund because it was the top performer during 94. So I sell my shares, but they're not worth $10,000 anymore. They're only worth $92.68. So now I take that $92.68, invest it all throughout 95 in the Europe, Asia, and Far East Fund, so now I want to take that 9,268 and pull it forward to the end of 95. So multiply by 1 plus the rate that it earned to the power of 1. My $9,268 is now worth $10,307. So I sell all my shares in the Europe, Asia, and Far East Fund and get this much cash, pour it all into the S&P 500 Growth Fund because it was the top performer in 95. that 10,900 or $306 would earn 23.97%. So at the end of 96, it'd be worth $12,777. Now I can just copy this across and Excel will make all my adjustments for me. So by the end of 2012, after chasing all the top performers, my $10,000 grew to $43,578. Now I can use the green interest factor table, side 1, to solve for what rate I've actually earned. I know I had a present value, a starting value of 10,000, a future value of this 43,578. My time was 19 years. And using that information, I can compute the interest factor and look it up on the green interest factor tables, just like we did at the beginning of the class. But I can also calculate it using the rate function in Excel. So if basically this rate function is just using the green interest factor tables. I would enter 19 as my number of time periods, no payment, a present value of a negative $10,000, and then a future value of this 43,578. And there is my, what they call my compound interest rate that I have earned, 8.06%. There's another way to calculate this in Excel using something called the geometric mean, the geomean function. And I never called the calculation that you were doing on your green interest factor tables the geometric mean calculation, but that is actually what it is. And this is the best way to measure your compound annual growth from an investment, instead of using the regular average function that I used on this table before. So I really should be calculating the geometric means for all my returns, not the average. The average has another name. You'll probably heard it called the mean or the arithmetic mean. A lot of times in grade school they'll just call it the average though. But what it really is what they call an arithmetic mean. So that's the standard average. But it's not a good number for measuring your compound rate of change in your wealth. I really want to know, since my wealth would have gone from $10,000 up to $45,000 or $43,578 over 19 years, what is that compounded annual rate of growth? And the answer is 8.06%. If I took the mean of it, which I did earlier, that's 11.42%. That's not really measuring my compounded annual rate of growth, though, like the arithmetic mean is. So the next thing I did is I had gone through and used this optimization program that I wrote in Excel to tell me the optimal weights to put in each of the 9 different indexes to achieve a dominant portfolio at different return levels. And I came up with these 3, 6, 9 different portfolios that I called A through I. And I have them, well, here was my original chart. So Portfolio A was comprised mostly of Barclays aggregate bond. I think 85% of it was invested in that. Oops. So 80, or actually 87% was invested in Barclays, 3% in the Europe, Asia, and Far East, 5% in the emerging markets, 3% in the Russell 2000. Investing in those weights and keeping your weights at that asset allocation each year would accomplish point A. Point B could be accomplished by using a different weighting scheme. It uses 85% of Barclays, 7% of emerging markets, 6% of Russell 2000, 2% of the S&P 500 growth. So basically, this is the asset allocation needed to accomplish point B. This is the asset allocation needed to accomplish point F. And you'll notice my points A through I are all dominant points. But these were used based on arithmetic means, because I hadn't explained geometric means to you. I have redone this entire spreadsheet, this time using geometric means. And you see I still get, you can see if I trace through my dominant points, I've kind of got this curved thing going on. That's called the frontier. I still have that same general curve, although after point G, things get a little different. Like point H isn't a dominant point on this graph when I use geometric means. It's not dominant because it generates less return than G does, and it has higher risk than G. So point H makes no sense. We shouldn't invest or use that as our asset allocation. Back when I was using arithmetic means, H did make sense because it wasn't dominated by G. It wasn't dominated by anything. You can see when I use geometric means, though, things change. Not necessarily by a drastic amount, though. But what I want to do is just pop in the point that was achieved when I chased the top performers. So I am going to add my chasing the top performers point, and it generated an X of, I think I have to enter this as a decimal, I'm not quite sure. I might have to change it. It generated a standard deviation, or my X value, of 24.98%, and it generated a Y value, or a return, of 0.0806%. And hopefully it popped it in there. I don't see it. Oh, there it is. Okay. I hope that's it. Can't seem to grab it though. So if I just right click it, format my data series, and set my, oops, wrong thing. I want to set my data label to be, oh, I'll figure it out sooner or later. I can't remember how to change that. Oh, oh my goodness, wrong thing. Oh, anyway, this is my chasing top performers dot. After all that, sorry to have wasted your time. But you can see chasing the top performers is not a dominant point. It generates a lot higher risk and less return than point G does. It generates a lot higher risk and less return than F does. Remember, let's see if I can get this to work. If I put my cursor on the chasing top performers dot and I draw a box to the northwest of that dot, any dots that fall in that box will dominate the, in this case, the red dot in the bottom right corner. So all of points C, D, E, F, and G, and then some of the individual indexes dominate the chasing top performers dot. So chasing the top performers is not necessarily a good idea. Actually, I can just say it's not a good idea. And this was actually, remember, I said it was a pretty interesting 20-year period because we actually had a couple of funds or indexes that did well in consecutive years. Or, so we never actually even, so choosing it this particular year, it was the top performer. We chose to invest in it for the next year when it was a top performer, and the year after that when it was a top performer, and the year after that when it was a top performer. So we actually ended up investing in the top performer for 3 years in a row during that time period, and for 4 years in a row for 2004 through 2007. So of the 19 years, for 7 of those years, we were actually in the top performers because the previous year's top performers remain the top performers. And it doesn't get much better than that. So even at a in a 20-year time period when the top performers had a few periods of consistent top performance, we still ended up in a non-dominant position over here. So I'm hoping to hammer home that the idea of buying low cost index funds, choosing your asset allocation, and rebalancing periodically to maintain that and not chasing the top performers is a good idea. Because I hear a lot of people arguing with me that they look how well this index has done. I want to stick with it. I don't want to diversify. Or look how well this stock has done. I don't want to stick with it. I don't want to diversify. Time and time again, we see that sticking with those top performers or following them and chasing their performance isn't going to work out for you.